Now, this is a brief overview of about the various indices in Indian listed space. The way to come here is resources, NSE India homepage, resources and historical reports, indices, and about indices. So within the NSE, actually it's not NSE, it is some other company called IASL makes these indices. And these indices are categorized as broad market indices, sectoral, thematic, and strategy. These are your broad market indices. You can count how many of them are there. 3, 6, 9, 12, 15, about 15 plus. And you have sectoral indices. How many of them? Same, about another 10 or 15, right? Autos, banks, financial services, FMCG, IT, healthcare, metals, oil and gas, pharma, private banks, public banks, reality index. And you have a thematic indices. These are theme, commodities, energy or ESG. This is the new fad. Things like that. And then you have strategy indices. This is the factor. This is what the latest catching up thing. I want to invest in value stocks, so I'll go for value index. I want to invest in momentum stocks, so I'll go for momentum stuff. Or I want to invest only in growth stocks. Or I want to invest in quality stocks. Or I want to invest in high beta or low volatility. There will be like thousands of themes like this. So now this is another 20, something the number you can count. As you are counting, the number keeps going up. And in future, this is May 2022. In May 2024, this number would have gone up even more. Why?
Getting listed added to them.
Why will the number keep going up?
The new companies will get listed and get added to the index.
That doesn't mean that you will get one more index, right?
It will get added to the number.
Maybe that is not the right answer, because there is already an index existing. I'm asking why the index number will go up, indices number will go up.
New and new themes might come.
New themes will come, and exchange will definitely be interested in doing that business, because exchange makes money in 2-3 ways. One is whenever you do a transaction, buy and sell a share, exchange charges a bit of it because they are facilitating the deal, called exchange fees. And exchange also makes money because they are providing you the latest data, like what is the current Reliance price. So they will charge. And now Reliance is a particular type of company, oil and energy. So let me add to oil and energy index, or let me add to retail. So I'll make more and more indices. And each index is charged. Now NSE has the incentive to make more and more indices because they can lend this data and then make more money. So this number will go up in future. It won't be here where it is. If you look at what is this? Morgan Stanley Index Company, MCSI, right? What is that? MCSI or MSCI?
MSCI.
How many indices are there? How many indices are there?
1,60,000.
That's the number. I mean, that's Google is answering you, right? So, and the number I mentioned here is maybe 80, right? 15, 15, 20, 20. So it will go up. Now, this is something which you should be aware of. Out of thousands of listed companies in India, in NSE, based on some criteria, it could be market cap, it could be liquidity, or a combination of both. You select top 10, top 20, 50 companies. That becomes
Hello. That becomes Nifty 50.
That
Good
becomes
morning,
Nifty 50, right?
I'm doing good, madam. How are you doing?
Excuse me, please mute.
Then you're not sent me the statement with
Sorry, whoever is that?
So
again, if there is any complicated
I think you can mute him.
Yeah, mute yourself.
Or you need capital gain, is it? I will send it across.
Sorry, what's his name? I will mute.
Sure, madam. I will send it across.
you're supposed to review some mutual funds, and you wanted all the mutual funds to be reviewed.
Hey, Jay,
No, no, no.
mute
We
yourself.
wanted to what you call
Oh,
Yeah.
I muted.
Go
Sorry.
ahead. Yeah, you go ahead.
Now this is the fact sheet of Nifty 50. What does it consist of? It consists of 50 companies based on some criteria like market cap and liquidity. The index is based on free float market capitalization. What it means is you take out the free float. What is free float?
Number of shares available to the public for trading.
For active trading.
Yeah.
Because the holding by promoters is cannot be traded, and even if they trade, there is a regulation.
Disclosure based trading.
And the shareholding held by mutual funds and foreign institutions is a little regulated, so it cannot be traded that easily every day in and day out. The portion held by the retail can be traded in and out every day. So that is free float. Now your Nifty 50 is free float. So you take all the 50 companies and calculate how much is available for regular trading and weight accordingly, and you get some index number. That is what your free float methodology. And this is your weighting. In Reliance has about 13%, HDFC is about 8%, in fee. This is the fact sheet. Now, what is my interest here is, if I buy Nifty 50, how much of India I'm buying? How much?
%66.
67%. Assuming all the Indian companies are listed, right? Okay, now I get 67% coverage if I buy Nifty 50 of all the Indian listed companies, right? And if I don't make, my company doesn't make to Nifty 50, I will see if does it make the next 100th rank. I mean 51st to 100. That is exactly your next 50 index is about. How much I get if I invest in next 50? This is 67, right? How much I get if I invest in next 50? 10%, right?
Yeah.
Yes.
Now this plus this is nothing but your Nifty 100 index. Right? Now, what you have is Nifty 500. This is all the 500 listed stocks. How much I make, how much I get if I invest in Nifty 500? The coverage?
96.
96.
It's as good as 100%, right?
Yes.
So don't bother too much outside Nifty 500 because 96% of your India listed space is covered in Nifty 500. Now, if I minus Nifty 500 and Nifty 100, what will I get? What will I get? Nifty 500 minus Nifty 100.
Nifty next 400.
Something like Nifty 400, right? That is nothing but this particular index. So 96 minus 77. How much is that? $19, right?
19.
We'll verify whether we are correct or not.
No, Nifty 400 should include all the top 400 for us, so it can't be 19.
Wait is.
Oh, this is mid. Oh, okay. So you are basically excluding the large caps and waiting only the mid and small. Okay.
Correct. So that is your 19. So your calculation is correct. Now this Nifty MSL 400 is split into two index. One is your mid cap 150, which is about 13%. and the next one should be 400 minus 150. So some 250 index. It is called small cap 250. And they should have about 6% weightage. %, right? So once you know this Nifty 50, next Nifty 50 and Nifty 500, Nifty 500 minus Nifty 100. Nifty 100 is nothing but Nifty 50 plus next 50. That will give you Nifty 400, and Nifty 400 consists of mid cap 150 and small cap 250. So you covered the entire 500 stocks, and you covered 96% of investment in India, and 96 is split into 67, 10, 13, and 6 accordingly. Now, if you were to invest in small cap 250, how much coverage you are getting in India?
6%.
So if India grows by 10% next year, you might get
0.6%.
yeah, 6% of 10%. If India grows by 10% next year, if you invest in Nifty 500, you get almost 10%. So you should know. Of course, this is just average numbers. You might get more, you might get less, or whatever. But this is the index composition in India, and you should be aware of it. And you should also be aware of where your stock is. And once any stock is in any of this index, it cannot be part of other indices, right? Did you understand what I said?
Yeah.
Yes.
Reliance only can be part of either of these four if it is in 500. Your Infosys can only be part of in any of these four once it makes into 500 list. Now, okay, so we know there are multiple indices exist. What should be the criteria to measure its performance, or how do we measure? And these are my two favorite quotes whenever it comes to quant investing or whatever. The first one is my mentor, and the second one is I don't know how many of you have heard about him. He's an expert, a real expert, kind of PhD material in at least 6 to 8 subjects. Statistics being one. He invented stamps, he invented maps. There are a few things like that. You wouldn't have heard of him, but his cousin you would have heard of him, Charles Darwin. So he's Charles Darwin's cousin, or the other way. Let's do equity curve of Nifty 50, just to start with. You should be aware of this website. This gives you the entire data download rather than Nifty NSE, which gives you only 1 year download. Let's download from which year? 2000. So we have 20 years of history. To date. You should follow this closely, and you should be able to replicate this on your own. Of course, you have the video, you have the template, but yeah, if you do it on your own, then you don't need my assistance. You can form your own independent opinion. Now, this is the daily data. Daily data is too noisy. I mean, the US market is very volatile last week, right? Yes or no?
Yeah.
But if you look at a weekly time frame, it was flat.
Mm.
You can go and check.
Yeah.
In spite of 3% up, 5% down, 2%. It just for weekly, it is flat or maybe 0.5% down. So the guy who is looking or trading or looking the numbers on a daily basis, he will say, "Oh my God, it's 3% up or 5% down today. What do I do?" Now the guy who is looking at a weekly, he says nothing happened. It's just 0.5% down. What are you talking? So we will restrict to monthly as our analysis because daily is too noisy. The way to do it is I want only month end close. I'm just writing a small if else if month of this is not equals to month of this. This is end of the month. Otherwise, I'm not interested. So these are all my month ends. Now I'll just save this sheet as.
Gaurav, can you just repeat that formula which you put in?
This one, if month of date is not equals to month of upper date,
Okay.
then I'm calling it as month end. Otherwise, it is not month end.
Thanks.
Let me save this as desktop. New folder. This is 7th May. You should save them as Excel workbook. Otherwise, your formula will go. So this is monthly conversion. Now I have monthly data. I am not interested in open, high, low, close because that's even another noisy figure. So I'm only looking at close. And remove those secondary dots. So this is my Nifty data, monthly data. Of all the various metrics that you should be aware, I will give you brief in the sense what is a must. There are tons of other metrics, but you don't need all of them. But what is a must, at least on a high level? So the first thing is returns, right? Change. This is simply B2 into 100 divided by B3. Okay, how many months of data I'm analyzing? This is simply count. So I'm analyzing about 22 years of history. So 20 into 12 is 240 and another 24, 268. And how many months I made money? Count ifs, returns being greater than 0. What is the percentage of those wins? This is into by this. So about if I don't do anything, I make money in 58% of the times, and I lose in 43% of the months. How much an average I make in a month? So on average, I get about 1.1%. This is just average. Sometimes we make more, sometimes we make less than this. And because average is tilted, in if you have a big month, it's obviously tilted. So let me look at the midpoint. So the midpoint is also the same, about 1%, 1.1 versus 1.13 for the average. That's because we have a large sample of 260 months, 270 months. And you also can make an assumption of, can calculate returns in quartile mode. Zero is the minimum value. 1 is the first quartile. Okay, so what does this quartile mean? What does that quartile of minus 2.35 means?
%25% observations are having minus 2.35%.
Yeah, 25% of the months below that number. That means 1 in 4 months, you lose more than 2.5% or 2.35. And other way is other way to state that is
75 times more than
75 times you make more than that month, right?
Yeah.
And your quartile 3 as well. This is the same interpretation. So there is a chance that you make more than 5% in 1 out of 4 months. We are due for that 1 in 4. I don't know when, because the last time was August 21 and May before that. We haven't seen in the last 10 months or 8 months. So we are due for this quartile 3 event. Watch out for it. When, I don't know. Then you need to know what is standard deviation. This is simply standard deviation. Okay, what does this number mean?
Volatility.
It's a form of risk measurement, and it is 6.5. Now, considering all the arguments that stocks are not standard distribution, they are log normal, this, that. Stepping back and assuming that stocks are normally distributed. Now, what it means is your average plus 1 standard deviation. Average plus 1 standard deviation. What is that number? You don't need to be accurate. You can just count 1.1 plus 6.5. That is 7.6, right? And average minus 1 standard deviation. What is that number?
-5.
Yeah, what is that number? 1 minus 6.5, minus 5.5. This is your 67% coverage, 1 standard deviation. Now, if I ask you, you have all the data, what is going to be your returns in May? May 22. What are the returns going to be in May 22?
Between these values.
The first best answer is I don't know.
Yeah. Obviously.
The second best answer is maybe at a 67% confidence level, May can give you a returns between -5 to 7. And if you want to increase it to 95% confidence, you multiply that by 2. Average plus 2 standard deviations and average minus 2 standard deviations. Right?
Yes.
Now you also can put how much I allow.
Or the 2 standard deviation means 2 into 6.53, is it?
Yeah, 1 this plus 2 into this.
Okay.
You also can say how much is the worst loss minimum of this array. In a month, you lost 27%, 26%. I don't know which month is that. You can go and check. That's the worst that can happen in a 1 month historically. In future, it may be more. because of the future is always bleak than the past. But at least you have a guidance. If you are trying to get into Nifty 50, what does it mean for you? What does it mean? Be prepared for a loss of 26% in 1 month. Right?
Yes.
If you can't withstand 26% loss of your capital, don't come into Nifty 50. There will also be a brighter side. The brighter side is how much maximum we made in 1 month. So there is a month where you made 28%. Now what I'll do is I want to know how much money I would have made if I had put 100 rupees in 2000. The way to do that is come down. I put 100 rupees and it is growing because I made 4% into 100 plus this divided by 100. And then I again made 7%. So it should be 111. Then I lost. Then I lost. Then I lost. Something like this, right? If you drag it all the way, this is what the equity growth or whatever you can call. So how much my starting capital? 100. How much is my final capital now? You have to help me.
1150.
Is D2. Right?
Yes. Yep.
Not bad. Your 100 rupees has become 1200 rupees. And the index that we have taken is Nifty 50. What you should ideally take is Nifty 50 total returns, where you get a dividend and you reinvest. So that number would be a little higher than this. Ideally, you should be using Nifty total returns, which includes the dividend reinvestments. And I don't use dividends because if I get like 1% or 2% dividends, right? I would consider that as my cost of doing business in terms of brokerage, slippage, a little bit of paying to the webinars, all things like that, right? So yeah, if I put 1 lakh, yes, I know that I'll get a dividend of 1000 or 2000 rupees, but I already paid 1000 rupees for this seminar. So I won't account, right? Yeah, but in a long run, they make a lot of difference. So use dividends. But if you don't, if I'm not using, because I'm giving a different explanation of that. Okay, how many years I'm in this business?
For us, one doubt in the dividend data.
Yeah.
What in the data which is provided by this website, which includes dividend, do they adjust for tax or they don't? They just
No, they
right?
can't. They can't because
of the slabs and all that, right?
They don't know your tax slab.
Correct. So, so it's the absolute return of the indices along with the absolute return of the dividend that is associated with that.
Correct.
Assuming it is reinvested.
Yes.
Fully. Okay,
Yes.
fine. Okay.
Now, how many months I have been doing, or how many years I have been doing? So, number of years is nothing but simple, right? This divided by 12. Yes?
Yes.
Now I want my CAGR, like how much I'm gaining per year. Is you can use or some other formula or this one. This is power of number. That is how many times my investment has become. And how many years reinvested, inverse of that, 1 divided by this. Into 100. So my year returns, annual returns are 11.5% or 12%. If you don't do anything, if you invest,
मेडिकल स्टोर માંથી દવા જો ને મળે તો લઈ આવ ને I'll send you મારો મોબાઈલ
Parikshit, mute yourself.
હા તો ત્યારે જ જાય છે इंटरनेट पैथेटिक है
Now this is not a straight path. I would be happy if I get 12% returns at the end of year, right? Each year, but it's not the case because you are losing in this month and you are gaining in this month. So what you need to calculate is how much gyrations it did. So that is today in reference to maximum I have seen in my 20 years life. And I don't want to drag this formula, so I'm going to log that 270. And minus 100. So I've seen some number which is very high. Now it is fallen to 3%. This one, the peak I have seen is 1178. Sorry, 1192. And right now it is down to 1153. So that's a 3% loss as of today. Now tell me the maximum of this or minimum of this. What is that? So at some point I've lost 55% than what I had earlier. So how do you read these numbers? If somebody can read it for me.
100 rupees invested 22 years ago would have become 1,154 rupees, compounding at 11.57% every year, and maximum drawdown. I think this should be in 2008. I suppose we would have lost around 55%.
Yeah. So your risk reward profile in Nifty 50 is 12% returns with a 55% drawdown, right? Now, if you are doing any investment on your own, you should be benchmarking against this. You should fare better than this. Either your return should be more than 11.5 or
Or it should have fallen lesser than the index.
lesser than the 55%. If you can't do it, don't venture. You accept this fact that you are going to get these returns and go with the flow. Now there are two other metrics that should be aware of. This is called Sharpe ratio. This is basically risk adjusted returns, blah blah. It has, as I said in the starting, each metric weakness and each metric has some positive things. Let's forget about the weaknesses, because anything you state, some other mathematician will come and say this is not the right way to do it. So forget all that, because we are not mathematicians. Just accept what is a good thing. It is a simple formula, right? So nothing but your return of the portfolio minus free rate divided by standard deviation of portfolio's excess returns. Let's calculate that. What is the risk-free rate? What is the risk-free rate?
Your RBI rate.
And it's a different places, right?
Yes.
So I don't know. The thing is, I have to go to the historical data set and plug in interest rate at each month end. Either I can do that, or I can just set some number. Risk-free rate, which is nothing but RFR. Let's take 6%, right? Just a number. You can plug in any number you want. I'm plugging in 6%. Or maybe 4 I should plug in. If I'm a US guy, I should plug in 0. Right now, 1%. Now, how much this number becomes monthly? Right? 12 in a year. Now, what is my excess returns? What is the formula? What is the formula?
Change minus
Return minus risk-free rate divided by standard deviation.
This one. Just only the excess returns. Right now, your Sharpe ratio is average returns, risk-free rate, this one, and divided by standard deviation of excess returns. This is monthly figure, right? Now to annualize it, you multiply by square root of how many periods? How many periods?
268.
12.
Or I mean, you monthly.
12 months. So your Sharpe ratio for plain Nifty 50 translates to 0.34. You can argue the good Sharpe ratio is somewhere around 1.5 above. Anything below 1.5 is a little risky investment or risky asset, and it's very difficult to get more than 1.5. So you live with what you get. If you think this is good, don't bother about this, right? Now, if you are doing any gimmickry of your own investments, what should you be targeting? What should you be targeting if you are doing anything on your own?
Trying to beat this.
Try to better this.
Yeah.
How can you better this? How can you better that? In the equation point of view.
By increasing the returns of the portfolio.
Either you increase the returns or
reduce the
there are two
device
ways.
itself. Yeah, reduce this fluctuation through reducing the standard deviation on the portfolio to increase the return. Return is
Yes.
anyway, yeah.
So there are two ways to make target higher Sharpe ratio. Either increase the returns or reduce the standard deviation. Standard deviation is another form of risk measurement. Maximum drawdown is one risk measurement. Standard deviation is another risk measurement. You can consider this also as another risk metric. The worst loss that you can experience in 1 month. The worst loss that you experienced over the life time. Or how much gyrations your portfolio is doing on a monthly level. Or the Sharpe ratio. Now there is the final one metric that you should be aware of, which is called beta. There are multiple methods to calculate the beta. The simplest thing is slope. This is CAGR method, which is covariance of your asset versus benchmark divided by variance of benchmark. Or slope. Slope of E1 to D1. What is E1? E1 is benchmark and D1 is your asset class, right? So write down that. Slope of your returns versus benchmark. So your beta is, you have your returns here and your benchmark returns. Benchmark returns, unfortunately, are the same in this case, right? So your beta would be, what is the formula? I've written there, no? Slope of your returns. This one versus benchmark returns. Because it's the same, you will get a beta of 1. Now, beta can be any number. So if beta is more than 1, what does it mean?
Your returns are better than benchmark.
So your guy rating, let's say beta of 1.5 means if market goes up by 1%, you go up 1.5%. If market goes down by 1%, you go down by 1.5%. That is what beta is about. Now, after the beta, you have another metric called alpha, which is Jensen's alpha or whatever they call. What is alpha? You read it, these links, whatever I'm using, you will understand a little more than this. There are a few brackets. One is RI, that is my investments. RF is risk-free rate. B is beta. RM, that's market returns. And RF, that is risk-free rate. So my returns. My returns are, where is the cell?
Column C.
This one.
Arrow.
Minus, I have to put a bracket. RF, where is risk-free return? This one, right?
Yeah.
Plus beta into
Oh,
beta into market returns.
market return minus history. Okay.
Bracket. Market returns are the same.
Same, yeah.
I'll put here some number. Okay.
Yeah.
Minus risk-free return. This.
Yeah.
This is benchmark. Obviously, I don't have any alpha because I'm comparing with benchmark. Ideally, I should have a positive alpha. Otherwise, I don't bother. Right?
Yeah.
You have a few other metrics that you should be aware. These are the final set. One is the correlation and R2. Correlation is my returns versus benchmark returns. It's perfectly correlated because it's a benchmark and my underlying investment. Now, if you plug in some other thing, then the numbers will vary. And R square, that is nothing but square of correlation. This into this, the same thing, into the same thing, or square power 2. What is this R2 or coefficient of determination or whatever means? is just come on. I can draw a line of my returns versus underlying returns and plot them in XY chart like this, and you get a line. And when you get a line like this, you can draw a trend line, which means you have multiple lines, multiple dots. I can't use paint properly. What happened? Can you see that line? Dot and another dot here. One dot and another dot here, and another dot here, and another dot here, and another dot. Now I want to connect all the dots. How do I connect them? In one straight line.
So
Somewhere like this.
yeah.
Now, out of those 6 dots, how many are on the line?
2.
And 4 are a little far.
Yeah.
2 are very far. Maybe you can consider this also nearby. 3 are on the line.
Yeah.
Means 3 out of 6 times I am on the line, and 3 out of 6 times I am out of the line. Right?
Yeah. Yeah.
That's exactly what your R2 is. So your R2, if it is 50%, 0.5, what does it mean?
50% of the time you are actually perfectly correlated with the benchmark.
You are basically tagging along with the benchmark.
Yeah.
Now, what is a good number that I should work with? I will delete this, right?
Yeah, yeah,
Delete this.
of course.
Okay, what is a good number to work with?
Anything above 50 or 60 is considered to be very good, actually.
No, I think it should be lesser.
No.
This one I'm talking about.
R squared, the higher the better. In this case, it's 100%. So obviously, because it's the same.
Yeah.
So yeah. So anything above 50 or 60 is supposed to be very good. 60, I would say, is considered to be, a portfolio or an asset which has a very little gyration as compared to the market's gyration over the.
There's no gyration involved here.
Or rather,
The
the
way that I
return.
look
The
it
return.
is-
I'm talking about the gyration in the return that is
No,
generated.
it is nothing like that. So the thing is,
I have a question.
if it is 100, which is 1, that means you are not doing anything special than Nifty.
Kora, I have a question. It's Krishna here.
Yeah.
Yeah. So when you're building a portfolio, would you want to minimize the correlation between the various investments?
That is with the R2, yes, because what I would ask you as a fund manager is all this data.
Yeah.
Now I would benchmark. Okay, this guy is doing better than 11.5. Okay, let me invest my money with him. And this guy is doing better than this, or his sharp ratio is better. Now, when he says his R2 is somewhere close, which is 95 or 100, what it means is this guy is not doing anything special. He is really doing what the benchmark is doing.
So we want it
I don't want to go
less
with
as
you.
possible.
I don't want to go with you because why should I pay extra fees for you? I might as well buy this one. Because this one is cheaper, right? Nifty 50 fund costs you only 10 bips per year. Mutual fund guy will charge you 1%. And if you say your R2 is 100 or 99, why should I give my hard-earned 1% to you every year? I might give 0.1% to that Nifty ETF guy. Yes?
Yes. Also, if you are thinking of diversifying risk across the portfolio, you don't want those different buckets to be correlated strongly, right?
Correct. You want something to go up, something to go down.
Okay.
Obviously, you want to go everything to go up, but that's not the case. At least if few of your investments are going down, let at least one go up. That's what your ideal condition is.
Right.
And that comes with
60.
So the less it is, the better it is.
I want.
No, it can't be totally.
Sir, I would say he is doing something different. He's trying his best. Right?
Right. Different
that can be good or that can be bad. Trying at least something better.
Depending on our portfolio strategy, how we want to place.
Correct. Now you have this information, right? How to do for Nifty 50. Where is this one? This is what shall I name this as? Equity curve, okay, or back test, whatever you can call. Now, give me, I just want to compare this with another fund. Another fund is IT. Okay, luckily it has the data from what I'm surprised is this one is at 45,000 and today it is at 30,000. I have no idea whether this data is correct or not. Assuming because it's a NSE data, we have to say it is correct. So the same thing, if month. Okay, 268 points we have. I'll just make a copy of this. And I will put IT fund. And IT fund monthly returns are this. Now my benchmark is the same. So what I'll do is I will break that formula. Ideally should be copying, right? Now my fund, IT fund is this one. So I'll just get this data into here. Just copy. This would be, I don't know, I'll just put the same number. Or actually you can put the starting number. This one. This is very bad. If you had invested in IT fund, what's your return, sir? I think there's something wrong with the data. Maybe because I doubt IT giving negative returns in last.
Yeah, I think data, there is some problem with the data.
Some problem somewhere. Maybe one dot is missed or something like that. Yeah, I mean, but
nevertheless, that's, you know,
that's what it is. I mean, that's the data that I got. So whether it's right data or wrong data, you can argue. I would say it's a wrong data. Yeah, let's look at FMCG. I think there's a dot missing there. Some. Because I don't want to work with negative numbers. I mean, negative returns. So it's nothing to. You'll straight away say, I don't invest in IT fund because it's negative returns, right?
Correct.
So there is nothing to discuss there. I would say FMCG and this is FMCG. This would be
3087.3.
0.4.
304.
All right. So now I have something to work with. Read. So if I am a FMCG fund manager, I would be giving you this data. What is the data I'm giving you? Read it for me. Benchmark would be now this one, right?
Average of H.
Yeah. So now what is it? How do you evaluate this? Simply get Nifty returns. You would have got anyway this, right?
Yeah.
Now you are venturing outside Nifty 50. This is Nifty 50. This is your fund, FMCG. Now you have side by side comparison. So will you go for FMCG or will you go for Nifty? You have the numbers. Read it for me, guys.
You would go for FMCG because you have higher return, higher CAGR, higher Sharpe ratio, lower correlation. Is that correct?
Correct. And also your R2 is much better. In the sense it's 44. He's doing something else than Nifty 50. It's clearly visible. So he is only 44% of the times he's similar to Nifty 50. Rest 56 times he's different than Nifty 50. So there might be a chance that in those 56 times, he might get better returns than Nifty 50, or he might get worse returns. Whichever it's fine. But he's only getting similar results of Nifty 50 in 44 months.
Brilliant, actually.
So I would go for this, and my returns are, yes, they're much better. Not much better, but at least I'm getting 0.5% extra. That 0.5% makes a lot of difference. See,
Because it's a 268-month data point.
yeah, 20 years.
Yeah.
So over a 20 years, if you save 0.5% or if you extract 0.5% more, that translates to 100 rupees difference in the final equity, right?
Yeah.
1150 and 250. That's a magnitude of 100 rupees extra.
1x extra of the capital invest.
1x extra of the capital, just for 0.5% extra CAGR.
How do we read the beta and alpha? How do we analyze?
The beta is very good because it's 0.6. Guide rate is Nifty 50.
So no, how do we interpret beta and alpha? I mean, how
Yeah,
do
it is 0.6. That means if Nifty moves by 1%, I move only by 0.6%, either plus or minus.
And what about alpha?
Alpha, I'm generating excess returns. I'm generating returns of 0.24% than Nifty 50 per month.
Okay, per month. So, but basically this.
You can actually multiply that by 12.
So
you get about 3, I think, right?
Yeah, but we didn't multiply that formula. We didn't multiply in that.
That's a monthly figure.
Yeah,
If you want,
right.
You multiply it by 12.
Right.
Or you say this is my monthly figures. This we annualized, but we didn't annualize this.
Yeah, and we. Oh, okay. We didn't annualize alpha and beta. Okay.
Yeah, so that is simply into 12.
Yeah.
Basically, CAGR and alpha goes in the same boat, kind of.
No, because you are adjusting for beta. Beta is a risk measure. Lower risk, higher the alpha. Even though returns are same, but because lower beta, you are getting higher alpha.
So we want alpha to be maximized and beta to be lesser.
Correct. And if you look at monthly returns, right? Actually, FMCG is doing poor. 0.1 only. Versus your benchmark of 1.13. And finally, you actually made more. So your monthly average figures are little useless. So you should look at CAGR. This whole business of average not matching with CAGR or alpha is a buzzword called volatility drag.
So basically, Cora, the FMCG falls less compared to market, so that's why
the rebound is easier. So 100 rupees falling 90% goes to 10 rupees. Falling only 50% goes to 50 rupees. From there, you make up 100% returns.
50 to 100 is 100%.
So your 50 guy will become 100 again, whereas that other guy will become only 20. Or even if he makes 500%, he will only catch up to 50.
He has to make 9x from that to catch up, to go back to those.
This whole thing is called a volatility drag, and that figure is reflected here. So higher the beta, it is difficult for you to recover because you are going to enter anyway here, right? You will definitely enter here in whatever the investment you make. Even if you think real estate is safe, but it is not. The prices will fluctuate in real estate. Gold, yes, it is not safe. Even the gold price also will fluctuate. The only price that doesn't fluctuate much is interest rates, but there also they fluctuate. Right now, we are in a low interest regime across the world, and it is bound to go up. So there also you fluctuate. There is nothing called MDD being zero. MDD being zero is your 100 rupee notes. If your mom has given you 100 rupees notes back in 2000, it is still worth 100 rupee note. That is the cash. So that doesn't go through MDD, but again, that goes through a different drawdown. What is that?
Inflation.
Yeah, that 100 rupees in 2000 is.
Purchasing power, yeah.
Right. So now you have a perspective of how to measure any of the investments, right? Any of the index, any asset class with this template.
Kora, I have a question.
Yeah.
Yeah, so the Nifty is made out of different sectoral companies. So here, if you're saying FMCG beta is less, I would say that they're going to be, if the FMCG companies which are part of the Nifty are outperforming, and there are other sectors in the Nifty which are dragging it down, right?
Yes, I mean, okay, this FMC Nifty also involves FMCG.
Yeah.
So you have to remove that component and recalculate.
So if we analyze this with regards to the sectors which form the Nifty 50 basket, it will be, adding more sectors here will allow us to know which sectors have lagged behind, pulling the Nifty down.
Yes, you can now we have the framework, right?
Yeah.
Download all the data, make it of your own. Instead of me giving to you, if you make, you will get a better understanding.
Yeah.
And it's a homework for you as well.
Yeah.
This is exactly what I've done. This is a bit outdated in the sense, I think this slide I would have prepared starting of this year, December. So things would have changed, but this is your various Nifty indices. CAGR of 12% and 29% MDD, sharp of 74, and worst month is 23, best month is 14. Now, if you compare, if you were to pick only one out of all these, what would that be?
Nifty mid cap 150.
That's because
High sharp and high CAGR. And also.
And the CAGR won't come into picture. High sharp, that's the only thing which comes into picture when you are comparing all asset classes. Right? Because if we want higher CAGR, I could have gone with micro cap. But it has gone through 70% drawdown versus your mid cap, which is only 40% drawdown. But it has higher Sharpe ratio. So if I had to pick only one, I would pick up mid cap fund. Similarly, for various sectors, what would be the sector which I would pick up if it is only one?
FMCG.
If it is two?
IT.
FMCG and IT. Similarly, these are various strategy indices. If I were to pick up only one strategy,
Low vol.
and beta, obviously, would be worst performing index because of volatility drag, what we have seen in that other sheet. I haven't put high beta index here, but you can put and make another line. If I were to pick up two indices,
Manual of momentum 30.
that Momo 30 and alpha low wall, right? Now the thing is, this again a slide from NSE. That's a link. This has tabulated returns from 2005 to 2016. You can actually do it for the rest of the years. What is happening there? Between various strategy indices, which are factors. These are nothing but
every strategy goes
factors.
either from being favorite to not so favorite.
They are all over the place, right?
Yeah.
This is like your cricket analog. Who is the best cricket team now?
No one.
No one. There should be some top ranked team, right? I think New Zealand.
New Zealand on the ICC basis, yes.
10 years.
Or Cora, you can take example of IPL also in terms of the teams.
I don't watch IPL, so.
Okay.
I mean, I watch only a little bit of Test cricket, and.
So in that matter, New Zealand is the #1 test.
If you go back 10 years,
I think Australia was one, and India also at some point of time was one.
If you go back 20 or 30 years back,
West Indies.
Right, West Indies was unbeatable. Australia was unbeatable 20 years ago. Now everybody is beatable. That's a different story. So nobody is going to be on the top forever, right? That's exactly what is happening here. Nobody can stay at top forever, on the top forever. I wouldn't make that statement of nobody is going to be at the bottom forever, because Bangladesh will always be in the bottom in cricket. So I would put high beta as it will always be at the bottom. Maybe 1 year it might perform, but if you look at 10 years, it's a very dangerous index. And another dangerous index is in India. What is the sector which is very dangerous?
Real estate. Reality
is one of the worst sectors. I wouldn't touch reality for my long-term investment.
Cora, can you just go back to the previous slide?
Which one?
The ones, this one, no, the other one where you quoted the NSE white paper. I just wanted to understand when this factors of alpha, quality, value, and low wall thing, what is the general market capitalization in terms of the companies generally in this strategies? Do they do it for, like example for alpha, is it for entire market cap or is it specified?
That's a deviation. I don't have time to cover in this particular session. Excuse me for that. But
not a problem. Just give me the name of the paper.
Yeah. So if you want, you go here, the same link, right? And this is a bulky document of 200 pages. Suppose you want to invest in momentum. Is momentum? This
there here, the new.
And this is your fact sheet, and this is your methodology. So this methodology document is about 200 pages. So you read it leisurely, you will get all the insights of how they construct. And I do a one-day class of how to do it on your own without relying on NSE. Various stock picks. That's exactly what we publish in the manual of momentum. Each month end, I will publish various indices and various strategy, momentum and low volatility. Yeah, I mean, because it's a summer, the reception is poor. Because actually there are only 3 guys who paid for this course, today's course.
Okay.
It is, if you call me as a money-minded, it is simply not worth doing this 4 hours class or 5 hours class for 3,000. But because there are other subscribers, I have to do it for them. So that way I'm doing, and I'm also a little excited in sharing my knowledge. So that way you cannot count money as the only factor. This is your snapshot index, which aims to track top 30 companies from Nifty 200 basket, and normalized momentum score. Normalized momentum score for each company is determined by its 6 months and 12 months price returns adjusted for price volatility. The weight of each stock is based on factor tilt methodology. The weight is derived by multiplying the free float market cap into the normalized momentum score of that particular stock. Stock weights are capped at a lower 5% or 5 times of the free float, which means it cannot go beyond this number, some number like this, maybe 8%, 10%. The index can be used for variety purposes as benchmarking or creation of index funds or ETFs or structured products. If you are creating an index fund, you have to pay NSE guy, because he will be giving you all these details on a regular basis. That's where NSE guy makes money. So now the composition of this particular Nifty 200 Momentum 30 index is 7% of Adani, 5.5% of Tata Power, 6% of Bharti Airtel, 5% of State Bank, 5 each in Titan, Grasim, Bajaj Finance, and Apollo Hospitals. Now the beauty of this is your 100 rupees invested in this particular index, for whatever the reason, if you liked it, is you own everything. You own 4 rupees of Tata Motors. You own 7 rupees of Adani. So you don't need to go on by Adani. That's the beauty of this ETF investing. Because if you want to buy Adani Enterprises, even one stock will cost you how much? I don't know. I don't track that. But I do know Bharti Airtel is at 700 base now. So if I have to buy only one stock of Bharti Airtel, it costs me 700. And now, if I put 100 rupees in this fund, I own 6 rupees worth of Bharti Airtel. Right? Does this make sense to go for ETF rather than stocks?
Yes.
What all stocks you like in the 10? These 10.
Tata Motors, SBI, Titan, Adani, Bharti.
Whatever you like, investing there, you invest in momentum fund.
Yeah.
Some stocks you may not like, but that's fine. But
that's correct.
Those 5 out of 10 stocks, instead of investing in those 5 stocks on your own, invest here. You are paying him 0.5% to do all these calculations for you and create a basket. But this is much better way than breaking your head of how do I invest my 1 lakh? Oh, 7% of Adani. Okay, how much I get? 1 stock, 2 stocks. It's a lot of work. It is not worth your time, especially if you are investing only 1 lakh or 2 lakhs, right? Because you can use that time elsewhere for better productivity or learn something new rather than trying to save that 0.5% or doing all these calculations on your own. With that, we finished the first portion. I would